Are we going to have a housing crash? That's one of the main questions on most people's mind, especially those who are either property investors or looking to become property investors. Let's look back at 2008 when we had the likes of Freddie Mac, Fannie Mae, many others by the way, who were packaging up toxic debt, and then you had ratings agencies like Moody's, Standard & Poor, who were rating those toxic debts as AAA bonds, and they were being packaged and sold as the best things in sliced bread. And then of course we saw what happened subsequently, and then obviously Lehman Brothers was left to fail, and there was a huge catastrophe globally, may I add. So the last housing market crash was in 2008, and as a result clearly of the global financial crisis, and it was horrific. Lenders were hit with shortage of funds due to the international credit crunch. I think before 2008 most people weren't aware of what the word credit crunch meant, but at that time it was a big buzzword and has been used ever since. And because of the credit crunch, there was a reduction in the availability of mortgages, and if you were around in those days you'll recall how tough it was. The Guardian reported that 1 in 10 houses that were being listed for lower prices than initially valued, and that by the end of the summer the number of homes that were selling had fallen by 50%. I mean, that is huge, it's massive, and at the time it was really bad. The average value of the UK property prices fell by 20%, and it took around about 6 years for values to reach pre-crash levels. So 2013-14, around about that time is when we started to see prices go back to where they were pre-2008. London, surprisingly, was the least affected by the crash, because obviously there's a lot of demand both in the city and then obviously from international buyers, so that was the least affected. The New Statesman reported that in Manchester and Leeds, new built flats were sold at auction for 30% less than they'd cost to buy. Now, I know some personal stories of people who had significant property developments, I mean very big, and the banks pulled the plugs. Banks in the UK pulled the plugs on big developments. I'm talking like £50 million plus projects all in all in different areas, but owned by one company, and they pulled the plug. One person had the plug pulled on a debt owed to a UK bank, 300 grand owed, and the bank said, sorry, need this paid ASAP. Unprecedented, I'd never seen that before. Need it paid ASAP, i.e. today, if not we're calling in the liquidators. And they did exactly that. Had they given that person, let's say, a month, he'd have sold a few properties even below cost, and he'd have paid them off. They weren't interested, or at least that's what I was told by the person who was forced to go into liquidation. Now, prior to the crash, 100% mortgages were commonplace, and interest-only mortgages accounted for about a third of all mortgages in 2007. And in those days, we also had something called vendor-paid deposit. So you could go and buy a property, and say the vendor's paying a 10% deposit, for example, okay, and then you'd still pay market price, but the 10% would be on top. Nobody actually paid the deposit, so people were getting 100% mortgages. They obviously, some of them couldn't afford to repay those mortgages, and that was just adding to the burden. I don't think we're going to go back there in a rush, but I'm sure something else will come up. Now, according to the figures from the Office for National Statistics, the house price to income ratio was 7.16 in England and Wales in 2007, and this had fallen to 6.35 by 2009. It really was a tough time. Now let's have a look at what happened in the late 80s, early 90s, around about 1988. So prior to this, in 1989 or thereabouts, and up to 1993, there was a housing market crash that came alongside a recession that was really awful. I remember those days too, so I'm showing my age, but that was really catastrophic. Now, the Telegraph argues that the crash was mainly caused by rising unemployment, 10.7% by 1993. That is massive, it's really big. And the recession also linked to issues with joining ERM in 1990 and attempting to remain within it until 1992. In the late 80s, interest rates were raised to 15%. I mean, that's massive. You can see where we are right now, and some people right now are talking about negative interest rates, and back in the late 1980s, 15%. I mean, 15% right now would cripple most businesses, most property investors, but back then we were at 15%, and that obviously made mortgage payments very difficult to repay. And then you needed more income, you weren't going to get more income, therefore you couldn't repay your mortgage. As simple as that. Interest rates did go down to 12% shortly after the UK's withdrawal from the ERM. House prices fell by 36% at that time, according to the Financial Times. In 1991, there were 775,000 repossessions. Over 1 million people were in negative equity at the time due to the crash. Now, towards the end of the crash, many of the restrictions on personal lending were lifted, which is believed to have helped bring the crash to an end. And it's argued that this sped up the demutualization of well-known institutions. So that's what happened in the late 80s. I've also covered what happened in 2008 and events leading to that. Right now we're not there, but are we going to have a housing market crash? That's what's on your mind. I think so. Once furlough ends in October and people are out of a job, unemployment is going to go up. There's only so much money that the government can print, and the more money they print, inflation goes up. That's not good for us either. And then they've got to increase interest rates to balance all of that up. That's not going to be good. So I think, depending on if or not we find the vaccine, after the first quarter in 2021, we are going to see house prices go down. Are they going to go down far enough to have a crash? Well, the last time we had one where the system corrected itself was 2008. So we're 12 or 13 years down the line. Every 15 to 20 odd years in the cycle, we have a self-correction. So we could be there. I think house prices are going to go down. So if you're looking to buy, it might be worth waiting until after March. And of course, in the UK, 31st of March is when the stamp duty, additional stamp duty relief that's been given for up to £500,000 is going to go. I think that's going to cause a further contraction in the market, and we are going to see prices going south. Keep watching. I'll keep sharing more with you as the days and weeks go on.